Several years ago, when I came to Madrid for the first time, I sent an email to Christian hoping to find a like-minded investor to talk about value investing for over a cup of coffee. Instead, Christian basically spent a whole week with me and introduced me to many of my friends that are here today, and just could not have been more hospitable. And I'm really appreciative of that, and thank you for being a friend, Christian. Appreciate you having me here today. As Christian mentioned, 16 years ago, Bynum and I started Cook & Bynum to do global concentrated value investing. We've been fortunate to outperform the S&P and the MSCI All World over that period. We invest both in developed and emerging markets. We're currently about 40%, a little over 40% in Latin America, for example. We've made 34 investments in 16 years. We typically have long holding periods, as that obviously requires. And we were believers in doing immersive research. We like to get on the ground, not just to meet with companies, but to try to understand the marketplace, understand what the customers are saying, what's driving them. And we feel like if we can understand the customer's demand position, we have a much better chance of predicting what's going to happen with the business. We're looking for companies that we're capable of understanding, that are have a durable competitive advantage that allows us to see into the future with that business. We're looking for management that we'd like to have as partners, and then we're disciplined on the price that we pay. Now, in the world that we live in now, it's difficult to find things that are cheap, and we find that things that we do invest in cluster in a couple categories. One is undiscovered, such as our Peruvian Coke bottler, Lindley, and the other is unloved. So what we wanted to talk to you about today was an example of what we think is an unloved company, which is Liberty Latin America. They're a leading cable provider in a number of lower penetrated, less competitive markets in the Caribbean and in Latin America. There are three classes of shares. The A share, they all have the same economic interest. The A shares are entitled to 1 vote. The B shares are entitled to 10 votes, but are basically totally illiquid, and the C shares are reasonably liquid and have no voting rights. John Malone has 6% of the economic rights of the company and 25% of the voting rights. I want to run through a little bit about the business for you. You can see they operate in Chile, Panama, Puerto Rico, and a number of other Caribbean islands. They're providers of, primarily the biggest business is hybrid fiber coax cable, providing fixed residential services in broadband internet, video, and voice. And then in addition, they're active in mobile in a number of markets. And then they have a nice subsea network, which we see a lot of potential in. Look at the sizes of these markets. Chile is the biggest. Panama and Puerto Rico on a normalized runway. Puerto Rico's numbers are depressed because of Hurricane Maria, but a normalized runway, Panama and Puerto Rico, the sort of tied for the second most important markets. And then they're in Jamaica, the Bahamas, Barbados, Trinidad and Tobago, and a number of other smaller Caribbean markets. In this fixed residential category, which is made up of fixed voice, video, and broadband, that's the category we like the best. Maybe it's the most predictable within the business, but they pass 6.4 million homes. Within those 6.4 million homes, they have 5.3 million revenue generating units. A revenue generating unit is any service that you sell to a customer that you pass. So if you sell them linear television and broadband, then that counts as 2 RGUs for your calculation. In addition, they have 3.7 million mobile subscribers, and they have the subsea fiber that we're going to talk a little bit more about in a minute. So why is cable a good business? We were a little late to come to religion on that, but we do like the characteristics of it now, and increasingly as DSL becomes a less competitive option. Cable is a data pipeline with high returns on investment if you're the only provider. But if you enter a market and try to overbuild someone else's network, you typically destroy the profitability for both players. So what you found is that they're frequently local monopolies because it doesn't make sense to be the second person to overbuild in a given area. In Latin America, it costs about $100 to pass a home, which is much cheaper than in Europe or the US, and about $150 to install at that home. And then with that, you can get $30, $40, $50 a month from that customer. So the returns on incremental capital are quite attractive. Here we have a scatter plot, just talking about some of the reasons why we like the business operating in the Caribbean and Latin America. We included Spain here just as a point of reference. But as I think this is obvious, as incomes go up, the demand for broadband goes up. We're also included on the slide most of Liberty Latin America's markets and a number of the other big markets in the regions where Liberty is not present. But the takeaway, of course, is just that as the middle class grows in these countries, you can see more demand for broadband. Another opportunity for the company is bundling. If you add an additional service to an existing subscriber, the profitability is almost, it's almost 100% profitable. It's really nice margins on the second service you sell them. So there are more opportunities for that to happen in the region versus what you see in the United States or in Europe. And one other way to think about this business is as a platform for consolidation. They're clearly Liberty Global, Liberty Latin America thinks about it that way. They see this as they saw this initially as they spun it off, and they continue to see it going forward. They talk about the M&A pipeline being full, but they want to consolidate and become a scale player in the region and be one or maybe the only scale player and take advantage of that. When I was in Santiago, Chile back in November, 4 different people came up in various meetings, and they asked me unsolicited what my favorite Netflix show was. And that had never happened to me before in Chile, but I think that gives you a sense of the growing demand for streaming content in these areas. So if you want to watch Netflix, you simply can't watch it in an attractive way over DSL. It takes about 25 megabits per second to watch a 4K stream. It takes 5 megabits per second, at least 5 megabits per second to get a quality experience on an HD stream and 1080p. And then with a 3 megabit stream, a DSL stream, you can only watch standard def. So this is admittedly cherry-picked as maybe the most extreme example, but Liberty Cablevision is Liberty Latin America's business in Puerto Rico, where their introductory offer is 100 megabits per second, and basically their only real competitor is American Mobile's 3 megabits per second DSL offering. Talk about the people a little bit. Liberty Latin America's executive committee is made up of John Malone, Mike Freeze, and Balin Nair. John Malone bought $37 million worth of Liberty Latin America at between $21 and $25 a share last summer. David Wargo, who's a Liberty Global director and a director at Discovery Communications, bought $1.4 million worth of Liberty last November, in addition to the $1 million he bought in 2016. Paul Gould, who's a managing director at Allen & Company, who is also a director at Liberty Global and Liberty Latin America, bought for over $5 million worth of Liberty back in 2016. Balin Nair, the CEO, has 600,000 stock options struck at roughly $21.45 a share on a blended average. So we have well-aligned people running the business that have deep expertise and experience. Just to run through the core markets, give you a better sense of that. Chile is the most important market, as we talked about. 93% of the revenues are in Chile are fixed residential. They're the market leader. They have a better offering than their competitors. Chile is our favorite economy to do business in Latin America because of the business-friendly environment and the consistency of that. And give you a little bit of a sense of why the offering is better. These are the speed test awards. I hope you can see this. These are the speed test awards from Ookla for last year. And VTR is basically double the speed at almost 53 megabits per second to their nearest competitor. So if you want a high-quality broadband to do streaming video, VTR certainly has an advantage. Back in 2016, Liberty Global issued the tracking stock, Liberty Latin America, in order to acquire cable and wireless business. They paid $7.4 billion for that at a higher stock price, admittedly. The major competitor is Digicel, which is the biggest mobile competitor in the Caribbean, and that's a very highly levered competitor. They're expecting synergies up to $150 million by 2020. Within cable and wireless, you find Panama, Jamaica, Trinidad and Tobago, Barbados, the Bahamas, and then a series of smaller markets. And then the last thing maybe to note is in this business-to-business number, this 27% here, which is 27% of 65% if you're following from the total, is where you'll find the revenues for the subsea fiber business. The network is extensive. It covers, I think, 40 countries in total, and a number of markets where they're not currently present. It's only operating at 10% of capacity. It'd be very expensive to replicate this. They get very nice margins in some of the places where they're the only connection only fiber connection available. And we believe that this will be a platform from which to do acquisitions, because you can fill up this pipeline and cut costs on the synergy side as you make acquisitions. The next market, which is Puerto Rico, is depressed. This number is greater than 15% on a normalized basis, pre-Hurricane Maria. It's 60% owned by Liberty Latin America and 40% by the private equity firm Searchlight Capital. Together they acquired Choice Cable, which was their primary competitor in the market in 2015 at about 6 times EV to EBITDA. And you could see since then, some degree, but as they're basically the only high-speed provider in Puerto Rico, the margins continue to improve, and we expect, despite the demographic challenges, which are significant in Puerto Rico, you have about 1% of the population leaving Puerto Rico each year, and you have public debt and unfunded pensions of about $120 billion versus $100 billion in GDP. So while we see the macro headwinds as being significant in Puerto Rico, even before Hurricane Maria, we think it's likely that Liberty Cablevision will be able to steal share. And much of the market, I think the market is basically writing this business off as if it's worth nothing. I take a look at Hurricane Maria knocked out, it was devastating. I don't know if anybody has any friends there, but it's very tough on the people in Puerto Rico. There's still 1/3 of the last night. I think it's a little better than that now, but about 1/3 of the people are without electricity. But the recovery is underway. Liberty Latin America expects their network to be completely up and running by April of this year. They were cash flow positive in January of this year. They are expecting somewhere around $100 million in insurance proceeds to help cover the rebuild in Puerto Rico. And then 2016, this is a frame of reference, 2016 EBITDA, or they say, just say EBITDA, in Puerto Rico was about $272 million. Oh, I'm sorry. It was $212 million. And we are targeting that to returning to about 90% of that 2016 level by 2019. So that's one of our assumptions. Their company expects to have $14 million in operating cash flow by the December of this year for the month. And they expect profitability this year to be half of 2016. So back to the question, why does the opportunity exist? We think there are a few reasons for this. The stock has fallen it was issued about $45 a share back to acquire cable and wireless, and it's rose to $48.90 back in July of 15, and it's fallen all the way to $21 a share. And we guess at some of the reasons for that, although I guess you never really know as a value investor as to why. But there's certainly tracking stock complexity. Liberty Latin America was hard spun off on January 2nd of this year, so it traded as a tracking stock for the intervening period. I think a lot of holders of funds that won't hold tracking stocks. I think this stock was spun off principally to European holders. European holders frequently can't hold Latin American companies. The natural buyers in Latin American funds frequently can't hold this name because it's got a majority of its exposure in the Caribbean, so it's not really a Latin American name in sort of a traditional MSCI definition sense, or what have you. The Cable and Wireless acquisition was considered rich, which we, I think, tend to agree with, and certainly non-core to Liberty Global's original European business. There are a number of issues that are sort of non-fundamental. One is hard to access. Before this year, where we got a decent set of financials for the spun-off company, if you wanted to build a set of financials for this company, you had to look within Liberty Global, pull out the Chilean business, pull out the Puerto Rican business, and pull out the Cable and Wireless business, make a whole series set of assumptions in order to build up what looks like a normal set of financials for the company. And that is still, you'll find if you look on Bloomberg and various other data sources, that it's still, the information is not well scrubbed, there are lots of mistakes, and it's difficult to find what's actually going on with the business. So we see that hard to find information is an advantage if you're willing to put in a little bit of work. In addition, there are a number of one-time charges, and we'll get into a few of those in a minute. Certainly the accounting earnings don't look very attractive for a series of reasons. The normalized earning power is not immediately evident. They took a $700 million impairment charge in 2017 related to the Cable and Wireless acquisition. They did a $150 million impairment in 2016 related to the transaction. We think maintenance CapEx is materially lower than what they're spending because we think a lot of it's growth CapEx. So right now, total CapEx is 19 to 21% of revenues, and we think that's more like 10 to 12. And then certainly the costs associated with the hurricanes come through here. I wanted to read you real quick a quote from John Malone that I ran across this weekend. If you're going to ask about quarterly earnings, you're at the wrong meeting, and you probably own the wrong stock, he told a group of TCI investors. What we care about is value. We want to create value for our shareholders, and I think the best way to create value is to have a long view, so that's what we do. So when we have the opportunity to expand to an area we think is going to have long-term value, we do it. We don't have to worry about the impact on earnings. So it makes a different kind of organization. That methodology has made a lot of money for John Malone and for the people that have followed him around. Take a quick look. So first of all, operating cash flow is not cash flow from operations. This is an internal metric that they use, and it's used in the industry. But it's similar to EBITDA. It's very close to EBITDA. But just to look at how we bridge between the two, you take 2017's operating cash flow, we expect $177 million in organic growth from Cable and Wireless and VTR, the Chilean business, by 2019. If you normalize Puerto Rico, that's about $100 million, and then we expect another $100 million in synergies from Cable and Wireless. So that gets us to this $1.5 billion in operating cash flows. Take a look at how that flows through. First, you have to deduct the 40% minority interest in Puerto Rico, the 20% minority interest in parts of Cable and Wireless. We assume a 20% tax rate, which is probably a little bit too conservative, but there are some reasons why it's not easy for them to avoid some of the taxes. And then we make an assumption of maintenance CapEx at 10% of sales. And that gets you to a very attractive, PE of 6.8 times. The risks to this are certainly a significant macro collapse in Puerto Rico. I mean, we're already seeing some of that, so if that got materially worse, if you saw a greater competition on the fixed side with overbuild in their markets, that certainly could damage their business. A mobile price war, which you see in a couple of their markets, could be quite significant if it would happen broad scale, but we think Digicel will remain a rational competitor because of the leverage that they have. One thing we spent a lot of time on was 5G, and whether or not 5G has the ability to eliminate the last mile problem. I think the short answer to that is no, and we can get into that more if you're interested. And then, of course, we expect fixed voice to fall, and we expect linear television to fall, although I think that's mitigated, the latter is mitigated somewhat in this market because people are paying $28 to $40 a month for their linear television, as opposed to 80 to 100 in the United States. So the incentive to pull the cord is not nearly as high, and linear television remains a very attractive, low-cost form of entertainment in the market. So our sources of expected return: mid-single digits organic growth, double-digit returns on invested capital, debt paid. John Malone has historically been a very intelligent capital allocator. The opportunities for debt pay down. They have about 240 million, I think it's 220 or 240 million left on their share buyback program that expires at the end of 2019. M&A opportunities. Just on February 18th of this year, they announced that they were paying $250 million of enterprise value to about 80% of Cable Tica, which is passes 40% of the homes in Costa Rica. And they're paying about 6.3 times EV to EBITDA after synergies for that acquisition. And, as of course the company has said, the pipeline is full. Questions?
Thank you. Thank you very much.